Give it up for Danielle DiMartino.
Danielle DiMartino.
Danielle DiMartino Booth.
The Fed knows that tariffs slow down trade to a greater extent. And if you look at real-time economic indicators, even all the way to super core inflation, which Jay Powell created out of thin air a few years ago, and that is services inflation net of energy, food, housing, I want to say, but it's a pure read on services inflation. And we just got the first negative print in years. The pandemic notwithstanding, we just got the first negative print since the Great Recession of 2007, 2009. And so the Fed is seeing, in no uncertain terms, with home prices turning negative month over month, S&P, Case-Shiller, as well as FHFA, they both saw home prices decline month over month in March. Shelter's the largest input to the CPI. So we're seeing disinflationary forces take hold, and yet the Fed is standing pat saying we better be vigilant about fighting inflation just in case, while Rome is burning, while layoffs are increasing, while most Americans anticipate rising unemployment in the coming years, and CEOs and CFOs are absolutely sitting on their hands and either firing people or delaying capital expenditure plans. So these are all hallmarks of recession, and they're universally being ignored right now by Jay Powell and Federal Reserve officials.
Hey everyone, and welcome to another episode of the WTFinance podcast. On this episode, I have the pleasure of welcoming back Danielle DiMartino Booth, regular guest, very well known. But yeah, Danielle is the CEO and Chief Strategist for QI Research, the author of Fed Up, and a global thought leader in monetary policy, economics, and finance. So Danielle, thanks so much for coming on the podcast again.
I'm happy to be with you today. I'm still fed up. It's been almost 10 years now, and I'm still fed up. So hey, good to be here.
Yeah, definitely, and I'm sure we'll see how long that lasts. But where I like to sort of start with my guests is starting very broad, and then we can go into the specifics. So what do you currently see in the economy? Has it changed since we last spoke 6 months ago?
Well, it's definitely continued to slow. There was a period of real exuberance coming out of the presidential election. In fact, if you look at the revisions to non-farm payrolls that we've now got through the end of 2024, it looks like net job losses began sometime in the second quarter of 2024. And then the layoff cycle kind of ebbed for a few months coming out immediately after the presidential elections in November. And then it looks like the economy slipped right back into recession at the beginning of 2025 with the resumption of private sector job cuts. And we know that there have been about 260,000 or so in the public sector in the United States on top of that. And, I think one of the other things that really has changed in the last 6 months is that it's pretty apparent the rest of the world is right there with us. The only thing that differentiates the United States is our central bank does nothing about it.
Yeah, and that'd be a great place to maybe go to, because I think, the ECB, we're recording on the 5th of June, they've just cut, Bank of England have been cutting, basically every central bank have been cutting, maybe except for the BOJ. They're very unique. But the Fed have decided to stand still despite all this data. What, do you buy their thoughts of tariffs and uncertainty, or what are they doing?
No, I don't buy what they're saying about tariffs. And you know what? The thing is, I don't think they buy it either. For the December FOMC meeting of 2024, I think it was December the 18th, maybe, on that same day, the Federal Reserve released the transcripts from the meetings held in the year 2019. And so it was a really unique prism into kind of the year that followed the beginning of Trade War 1.0 in 2018. It feels like a lifetime ago at this point, but it was April of that year, I think April of 2018, that Trump sent out the first tweet at the time, basically launching a trade war with China. And what the Fed discovered 1 year later was, in fact, the CPI had fallen. It was, I believe, 2.4% in 2018, and by the end of 2018, 2019, it was 1.8%. So we actually saw inflation decline, and the Fed discovered that the bigger economic impulse, if you will, was the slowing in global trade that was causing layoffs and a slowdown in economic output, and that was the greater force on the American economy. So the Fed knows that tariffs slow down trade to a greater extent. And if you look at real-time economic indicators, even all the way to super core inflation, which Jay Powell created out of thin air a few years ago, and that is services inflation net of energy, food, housing, I want to say, but it's a pure read on services inflation. And we just got the first negative print in years. That the pandemic notwithstanding, we just got the first negative print since the Great Recession of 2007, 2009. And so the Fed is seeing, in no uncertain terms, with home prices turning negative month over month. S&P, Case-Shiller, as well as FHFA, they both saw home prices decline month over month in March. Shelter's the largest input to the CPI. So we're seeing disinflationary forces take hold, and yet the Fed is standing pat saying we better be vigilant about fighting inflation just in case, while Rome is burning, while layoffs are increasing, while most Americans anticipate rising unemployment in the coming years, and CEOs and CFOs are absolutely sitting on their hands and either firing people or delaying capital expenditure plans. So these are all hallmarks of recession, and they're universally being ignored right now by Jay Powell and Federal Reserve officials.
Yeah, exactly what I was going to say. Every day it seems like a massive multi-conglomerates, laying off 10% of their workforce and cutting capex and doing, it seems to be the trend, linking it to some uncertainty. Do you think he's worried about a potential COVID situation where this all somehow gets reversed and there's a massive, boom of all that money that's left on the sideline that hasn't been invested?
Well, I mean, the last time that we really had inflation generated, if you will, it was because of the transmission mechanism. And that was what Ben Bernanke once called helicopter money. We delivered money directly deposited cash into U.S. household bank accounts, and lo and behold, they took the cash and spent it. And demand was stronger than supply, and therefore inflation went up. But it was critical that we were giving Americans cash money. And right now that's not even being contemplated by Congress. They're in a knockdown, drag out pub brawl about extending tax cuts. And the only thing that will do is prevent a negative shock to the US economy. It will prevent a negative shock by extending these tax cuts, but there's not a word being spoken about providing stimulus of the kind that was legislated in the aftermath of the pandemic.
Yeah, you're completely right. And it does seem, it seems very weird that he had those 100 basis point cuts last year before the election, and now there's sort of nothing since. I don't know if it's conspiracy theory. Do you think it could have been political?
At the time I said no, because at the time the Beige Book was saying you better be cutting rates, and companies were laying off, and the bankruptcy cycle was accelerating. All of those circumstances exist today. They're just worse. And so at the time I advocated for the Fed being apolitical, but satisfying its need to minimize inflation and maximize employment and cut rates. The fact that they're not cutting rates right now, however, is beginning to look very political to me. And disturbingly so. I've been highly critical in the research that I've published over the last several Fed meetings because just to take one example, the Beige Book came out and said all 12 Federal Reserve districts see weakening demand for labor. The Beige Book is much worse than it was in September of 2024 when they pushed through a 0.5 percentage point rate cut, and yet the Fed is ignoring it. The University of Michigan, 64% of Americans think that the unemployment rate is going to rise in 12 months' time. That number was a fraction of what it is today back in September of 2024. So in other words, the data is a lot worse, and yet the Fed is dismissing it. And if they're supposed to be data dependent, the only explanation for the Fed not moving, again, we've got truflation, TRU-flation at 1.88%, and we've got other real-time inflation metrics that are disinflationary right now. So the only explanation that you have right now for the Fed not easing monetary policy, as is the case with so many other central banks worldwide, is because they're doing it to harm the current administration.
Yeah, and I guess the concern is, there's midterms next year. That's when Powell's probably going to get voted out anyway. So you hope that that's not the case.
Well, that might be the case, but Powell's term as a governor, which is a 14-year term, is actually up in February of 2028. So it remains to be seen what's going to happen with Jay Powell. The vice chair of banking and supervision, Michael Barr, he resigned from his 4-year tenure, from his 4-year position as vice chair of banking and supervision, and chose to stay on the Federal Reserve Board. And to finish his term, Jay Powell has that same legal right, meaning the only vacancy that could theoretically come open during President Trump's term would be this coming January, when Adriana Kugler's term ends, because she was filling out the end of somebody else's unfinished 14-year term. That may be the only opportunity that Trump gets to put a chair in place, a future chair in place for May of 2026, when Chair Powell's term as chair ends. In which case, if Powell decides to not step down at that time and to finish out his term, which ends in February of 2028, the president's only option would be to choose somebody who was already sitting on the Federal Reserve Board, meaning January is his only chance. In theory, most people expect Jay Powell to leave the minute he can. But if that was the case, given the political heat, why wouldn't he be quitting now?
Yeah, great point. From what I've heard, Christopher Waller maybe sort of trying to align himself with sort of what Trump's thinking, and I guess Besson to potentially be voted in after that. So that may be another option. And then, as you said, they can bring someone else in next year.
So they can bring Warsh onto the board, and they can choose between Waller and Warsh when the time comes. Same letter of the alphabet.
Yeah, definitely. And then what do you see in the bond market? Because I guess it's sort of it seems to be a real issue. As you mentioned, there's the new tax or there's a new budget coming through, which is basically increasing deficits. Doge is being destroyed. We're not going to hear about it again, probably. So yeah, do you think this is a real issue, and is this something that can be resolved?
We'll see. There are a lot of very large hedge funds that are positioned to profit if bond yields rise. And so they have a vested interest in saying that debt and deficit spending matters. Whereas a few years ago, when the debt was growing at an even faster pace and we were pumping stimulus into the economy like drunken sailors, those same individuals were positioned differently. And so at the time, it was okay for deficits to not matter. It remains to be seen, really. And the behavior of long-term bond yields, the weaker the economic data get, the harder it is to maintain that upward pressure on yields anytime the long bond yield approaches 5.0%, anytime the 10-year yield approaches 4.50%. There seems to be some kind of a ceiling because the economy is so weak that we then see yields come back down, which is exactly what we're seeing today.
Yeah, definitely. I know some people have mentioned that, maybe the BOJ increasing rates could be actually increasing the global rates, yields as well. So that could be potentially a sort of a butterfly effect that's occurring.
It definitely plays a part, but we knew going in that because Japan was mostly a bond market that was owned domestically, that it would not have the same impact globally on other bond markets. And indeed, that would help explain, again, why there appears to be this pseudo ceiling on U.S. bond yields, or as we tape this on the 5th of June, we wouldn't have the 10-year yield at 4.39%.
Yeah, definitely. And it does seem interesting as well with the dollar, how it's depreciated, even though, rates have been held quite high, despite, Europe's decreased them by nine times in a row or something like that. So it is interesting how it seems like there is this trade occurring as well in the dollar.
Yeah, and we forget that we can talk about the bond market all day long and on Sunday, but at the end of the day, the deepest, largest trading market on the planet, I think more than $7 trillion a day in volume, is the currency market. And you're right, that's where a lot of the action has been. And some people are rightly questioning whether or not these moves are sustainable, because as we know, a lot of other countries' banking systems never did really get cleaned up after the great financial crisis. So we shall see.
Yeah, definitely. It does seem to be sort of a massive load off the rest of the world. The US dollar seemed to be really, with lots of countries having US denominated debt, it seemed to be putting massive pressure on basically everyone. And now this could be helping them quite a bit.
But we saw this, right? We saw this in 2007. We saw this in 2022, or in 2020. There have been periods of prolonged weakness in the dollar that have then been unwound. If you look at a very long-term chart, it helps to try and be calm when others are panicked.
Yeah, definitely. It is very cyclical. So what do you see in the next 6 months? You mentioned that it looks like the US is already in a recession. I'm assuming that you think it's going to continue down that trajectory. And would it require the Fed actually taking drastic action to change that, or what would be required to change that?
Well, most Fed officials right now are saying, September at the latest. It would not surprise me to see something in July, especially if we continue to see jobless claims increase. Where they are right now in the current post-pandemic cycle is they're experiencing a third wave of increase, and it looks like that could very well continue. And then by the end of September, we have, hundreds of thousands of government employees. We don't know the exact number. Reuters puts it at 260,000 that have been taken severance packages, left early, been fired, et cetera. But Reuters said it was around 260,000. In the example of the ones that are on severance, that runs out in September. So there really isn't anything outside of dramatic legislation, dramatic deregulation that occurs quickly and is not kind of stalled in the court system. It seems like every step forward taken, at least in the eyes of the administration, you're seeing a roadblock put up in the US court system. So unless there's something dramatic that spurs private investment, a revival of private investment, a reversal of these plans to cut capital expenditures, companies beginning to increase the size of their workforces. Barring that, I can't see the Fed not continuing to be behind the curve and beginning to cut in July. I'm surprised they didn't cut in May, given really how bad the soft survey data has been. And we're talking about University of Michigan data that goes to 1968. That's the series inception. And when it's at levels that it's currently are at, we're deep in recession. And again, this is just something else for us to add to the long list of things that the Fed is ignoring right now.
Yeah, definitely. We saw how lagged the increase in interest rates was. So I imagine it's going to be a similar impact once they cut, and it's going to take, quite a long while for it to actually reverse.
Long lag time, easing and tightening.
Yeah, definitely. And so you would see, would QE be their first action, or I guess they talked about they wouldn't do QE unless they get down quite low in interest rates. So,
well, I mean, a prerequisite for QE, at least at the Fed, is getting to the zero bound. And so we got a mighty long way to go to get there, unless there's some kind of an emergency and the Fed wakes up one day and says, oh, look, we just drove the US economy off a cliff, so we're going to push through unusually large interest rate cuts. That could easily happen.
Yeah, okay, definitely. And you mentioned there the rest of the world is actually not in a good position as well. So it'd be interesting to hear your opinion, I guess, on Europe, the UK, China, whatever other countries that you're watching, and why you think they're struggling as well.
So, just a few days ago, we saw news out of out of Germany that its service sector had fallen into contraction. I think that took a lot of people by surprise because there's been something of a manufacturing renaissance by force because Europe is spending more on its defense spending. So there's kind of some movement in the industrial sector, if you will. But again, we've seen weakness in construction and in the services industry. This is something that is occurring on the continent. We've seen weakness coming out of China as well in a lot of their surveys. So I'm not sure who's going to pick up the baton here and be the leader of global growth right now.
Yeah, okay. So it definitely seems to be an issue. And then do you think I'm guessing, do you see it as being a crash, or do you think it's going to sort of be a weaker recession, or what would you compare this current sort of cycle to? Is there anything similar in the past?
I think the closest parallel right now is the 1980, 1981 double dip recession that we saw in the United States. The United States had a pretty brief, violent 6-month recession in 1980, and then it came out of it the same way it looks like the United States had, a bump in growth towards the end of 2024. Ronald Reagan came into office, federal payrolls were slashed, the economy fell into the second phase of a double dip recession. And believe it or not, that was called the Great Recession before the 2007-2009 episode occurred.
Yeah, okay, really interesting. And then how do you see, I guess there's quite a lot of people who have actually taken themselves out of high risk assets. They've taken themselves, there's lots of money on the sideline, taking themselves out of equities. Do you see that as the right plan? Do you think there's going to be sort of a bond play and sort of, I guess, precious metals and other sort of safe haven assets that are going to benefit in the coming 6 months, or how do you see that?
Well, it certainly seems like silver's the trade of the moment. That's no secret. But again, yes, people are more defensively postured. A lot of the rally that we've seen has been attributable to retail investors. And of course, we know that the biggest driver of risky assets is simply flows. So until you have kind of this mammoth machine of Americans who are 70 years and older decide that they're going to start selling their stocks, we really won't have that passive structure tested. And to speak clearly out of the other side of my mouth, that's one of the reasons the Fed is trapped. To the extent that they lower the interest income of individuals who were able to go back into the workforce in 2001, go back into the workforce in 2007, but now they're 70 and older, so they can't go back to work. The only choice that they're going to have is going to be to start to sell off that 40% of the US stock market that they own if the money that they're making in the safest assets in the money market starts to decrease. And so that's one of the areas that really puts the Fed in a tight position.
Yeah, that's really interesting. And I guess it's very hard to track when that would be the case once the baby boomers start selling their assets, but do you have a timeline, or is it just too hard to?
So Simplify Asset Management's Mike Green did some really simple back of the envelope math. For every 50 basis point rate cut, corporate America benefits by about $27 billion in terms of saved interest expense, but it also takes $61 billion out of the hands of retirees in terms of interest income. So that's your trade-off. It's a 2-to-1 trade-off. And again, the baby boomers, they were young enough to go back into the workforce. This time around, if they lose enough in interest income such that they're not able to pay their bills living on fixed incomes and unable to go back into the workforce, then the only choice that they'll have is to start selling their stocks. And I would venture to say that might be, as soon as 100 basis points from now in terms of Fed cuts. But it does help explain a fundamental reason that the Fed finds itself in such a tight corner, because you don't want to be the central banker who tests passive investing. It's just doesn't look good on your resume.
Yeah, no, definitely not. So Danielle, thanks so much for your time today. We sort of covered all different areas, but I really appreciate it. But my last question is, what is one message you want people to take away from our conversation?
So this is a message that I will reiterate, and that is there are enough people losing their jobs in the United States that you likely know somebody who has. And so the message that I continue to repeat is, this is a time to be a good family member. This is a time to be a good member of your community, a good neighbor, and do what you can to help others in the event that they happen to be directly affected by what's happening right now in the economy.
Great, that's a great message. So thanks so much. If anyone wanted to find out more about your work and what you do, where would the best places for that be?
So QI Research, DiMartinoBooth.substack.com. QI Research is coming up on its 10-year anniversary of being in existence. I left the Fed almost 10 years ago, June 12th. So we're going to be running some great promotions, and for the first time for institutional investors as well. So come see what those are. Love to have you part of the Daily Feather reading community. And if you don't already follow me at DiMartino Booth, please do.
Great. I'll put all this below, but thanks again for your time and congratulations on 10 years.
Thank you.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that, but it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.